So let me throw out a challenge to you today. Are you saving in a way that you're gonna pay tax on the small number or the bigger number? If I were to ask you if you wanted to be taxed on the seed or the harvest, most people say the seed. But the way that we have been taught to save in this country has put families in a position where they're actually inadvertently set themselves up to be taxed on the bigger number. Today, I'm gonna explain this in really a way that you may potentially want to consider the way that you're saving for your future retirement. Keep it right here. Hey everybody, Chris Heerlein here of REAP Financial and host of Retire Ready TV on KXAN, host of Wealth Radio every Saturday, 11 a.m. on News Radio KLBJ. Thanks for tuning in with me today. If you enjoy our YouTube channel, please hit the subscribe button down below. So like I said, do you want to be taxed on the seed or the harvest? I've talked about this for a lot of years, but still, many folks do not consider their savings plan. Now, I've said this for decades. Listen, the way you're saving is just as important as where you're saving. The amount that you are saving every month, every year, it's just as important as where you're saving. The reason is because there's little thought to how you're gonna get the money out of these accounts someday. Now, our financial religion for years has been to not pay tax. Nobody likes to pay tax. I get it. But at the end of every year, you're considering filing tax with your CPA, or maybe you're a do-it-yourselfer, and you're like, is there any last-minute things that can be done? I want you to stop right there, because that's a reactive approach. I want you to think today about where you're saving and how you're gonna get the money out, because if you're getting a tax deduction today by putting money in an IRA, when you contribute to your employer 401k, you're likely getting a tax deduction there. If you put money in a SEP IRA or a spousal IRA, a simple IRA, all of those can provide annual tax deduction. And that money is gonna go in, hopefully it's invested, and it's gonna grow. And for many of you, it may grow for decades, or it's grown for decades. And each and every year, you've gotten a small tax deduction on the money you've put in. But now when it comes time to pull it out, and that small amount you put in has grown to a larger number, now we've got to pay tax. Now the good news is if you're working or you're still saving, well, right now in this country, as of the date of this video, tax rates are as low as they've been in 40 years. But in 2026, as we walk into 2026, just a couple years away, here's what happens. Tax rates are already set to go up, no matter what the administration today or tomorrow. So let me ask you this. Do you believe that taxes will be higher in years to come, in decades to come, than they are today at 40-year lows? If that's the case, if you believe they may be, then why aren't you saving in a way that you can be taxed on the seed and not the harvest, not the bigger number? If you believe that taxes could be higher and yet they're so low today, why not pay the tax today so that it can forever grow tax-free tomorrow? Again, this is not the way we've been brought up. It's not in our financial religion, but maybe it's not an all or nothing. In many cases, it may just be repositioning or redirecting some of the dollars that you're saving. If I were to sit down with you and ask you, where is the bulk of your wealth saved? It's probably your IRA or 401k. And if it's not that, it's probably your brokerage account. All three of those types of accounts will be taxed at whatever tax rates are down the road. If you have a Roth 401k or a Roth IRA, I commend you. But is it today your smallest account? Think about the portfolio. Is it the smallest account you have? And if you have one, it likely is. And it's because it's been more of an afterthought. We like that tax deduction today, but you need to be considering proactive tax planning so that you can keep more of your wealth each and every year. That's then working for you as it's invested, which can prolong the longevity of that portfolio for your success in retirement. The last thing I want to touch on is control. Every dollar in the 401k and IRA will be forced to be taken out, whether you need it or not, once you get into your 70s. And for those that have done a great job of saving, our very own clients at REAP Financial, what they find themselves in is a position where they may be in a rather low tax bracket today, but when that day comes that you have to take money out of these accounts, it can create a tax bomb. You could jump a bracket or two literally overnight in the year you're forced to take it. And not only are you going to pay tax on the IRA and 401k distribution you're forced to take out, you're now paying more tax on Social Security. Your Medicare premiums, as we've showed you on our YouTube channel, can escalate dramatically. And remember, once that day comes, you have to take the required distribution. Well, more than likely, it's going to continue each year. And the way that it works is the government wants more each year, which means that income amount likely could go up. So you can find yourself getting stuck in a higher tax bracket in later retirement when tax rates may be exponentially higher. I think we're getting the point here. So listen, if you want to get into the Roth game, there's a lot of misconceptions around this. But if you have a single dollar in your IRA or 401k, you can do it. And I want to show you how to do it. I want to get your hands on my Roth Decision Guide. It's been updated here for this year. It's got all the ways that we can utilize Roth IRAs in your portfolio to keep more of your wealth. Email me right now, retire@reapfinancial.com. Retire@reapfinancial.com. Get your hands on our Roth Decision Guide. It's of great value and it's a no cost for all of our YouTube viewers. Until then, all the best.